Jeffrey Cleveland, let's get some straight talk about the economy because people can get lost in all the facts and fact-checking during a presidential campaign. Let's start off with jobs. We got a big jobs number, the September jobs number coming out on Friday. So where do you think it's going to be?
Look, Greg, the last 12 months have seen about 200,000 jobs added each and every month. I think something around there, maybe a bit below, would be perfectly reasonable for an estimate. But I think when people focus too much on that number, monthly it can be noisy. And if you step back, you look at the jobs market, we have more job openings than ever before on record all time. We have fewer layoffs at record lows, especially as a share of the labor force. And we have pretty good job growth. So all in all, we have the best labor market, we think, in 15 or 20 years. And I think that's the real story.
All right. So what's the real story on inflation? Because the Fed is still waiting for it. Are you?
The Fed is waiting for inflation because they tend to focus on one particular gauge of inflation, the core PCE, which excludes food and energy, and happens to be just shy of 2%, Greg. It's 1.7% year over year. You know, the way we look at it, core PCE is very often just below 2%. Most of the time, almost 80% of the time in the last 20 years. So that's not unusual. And then if you look at a wide array of other measures of inflation, so beyond just focusing obsessively on core PCE, if you look at median CPI, core CPI, those are all above 2%. So inflation is at or around 2%. It's not deflation, Japan style. It's not runaway inflation, but there's inflation there.
All right, so we have jobs, we have inflation. Let's bring it back to the campaign for 1 second. Is there a link between the election and a potential recession? Because if you listen to the campaign trail, things aren't that great out there.
There's not a link between the recession and the election. You know, if you look at elections and you ask, in the next 12 months after elections since 1900, how often were they followed by a recession? It's rare. It's 1 in about every 3. But sitting here right now, in any given year, it's 1 in 4 chance, so 25% chance of a recession. So the difference between the election year and a regular year is not significant in our view. So don't worry about an impending recession. In fact, Greg, I think the cycle can push on for a bit longer. I think one of the things I hear most is that we're at the end of the cycle. And strangely enough, I've been hearing that each of the last 3 years in succession. And I think this will be a longer, more drawn-out cycle, so we have more room to go.
All right, so what should investors be doing if this cycle is going to continue?
I think very near term, I think investors, I have a concern because bond investors have become very comfortable that there's no inflation, that rates can't go up. And I think that's wrong. If you listen to the story we're telling, there's some inflation, the employment market is good, the job market is good, that means the Fed should be hiking. So I think front-end interest rate increases are closer than they may appear. I think there's also implications for the longer part of the bond market as well. Again, investors believing that we're in lower for longer, they may be shaken in that belief, I think, a little bit in the future months. So that's something to be aware of. Longer term, though, if we're right that the economy is in good shape, that things are moving in the right direction, that should ultimately be good for spread sectors, so your high yield, your investment grade corporates, they should be fine. It should also be good, Greg, for stocks. Be worried about stocks in the short run if there's a disruption here due to an interest rate hike. But longer term, if we're right about the economy, we should also be, pretty optimistic about equities as well.
All right, sounds good to me. Thanks a lot, Jeffrey.
Nice to see you, Greg.
And thank you for watching The Street.